Welcome, ladies and gentlemen, to a new issue of the Grey Market Talk with my fabulous friend, former portfolio manager, market vigilante, market maker, bond trader, crypto early investor, fantabulously rich dude, Nick, who finally splashed out on get himself a green screen behind him. But now we've discovered we have microphone problems. So I recommend it. Nick, why don't you spend like I did, $29.95 and buy a lovely little microphone?
Yes, well, as I said, I just spent 60 quid on her headphones, and they're obviously not good enough. So I'll bite the bullet.
I'm a bit of a cheapskate. I always start with the cheapest stuff first because I know if it's crap, I can throw it away. If I'm lucky, I'll stick with it. So lovely. What we're going to do today, let me do a quick share of my screen. Obviously, we want to talk generally about in which position the markets are. Oops, nope, I haven't done that yet. I have to press the presentation button, now presenting, and now I'm going to share it. We want to discuss how markets do in general because, well, we've seen a fantastic run up again to new magic levels. And we have the 12th of May, 2024. When do we start working for ourselves? That's a couple of months out, right? At the moment, we're still working for the taxman.
Are we?
I think yes, yeah. More than half a year, and then for the administrators and the authorities, and I don't know what. But we forgot the biggest topic of them all: Eurovision Song Contest last night. Nick, did you watch it?
Fortunately, that went straight over my head.
I did. What a waste of time. Okay, let's not have it. Motivational slide of the week. You probably got that as well. Nick had it when I introduced it to him, but I thought it was so brilliant I have to get it in. You see a little boy sitting on the left, depressed, looking sad, and says to his mom, "The kids at school keep picking on me since Dad's flagship fund didn't even beat the S&P this year. They even started calling me Levered Beta Boy." That's when I almost wetted my pants. And the mom always said, "Sweetie, you need to understand all that matters is assets under management. Your father's fund brings in over 100 million on management fees alone." And on the right side, we see a chart which AQR Capital Management was in my LinkedIn box as well, but I liked it. It showed if you would have invested $1 in Berkshire Hathaway, Warren Buffett's company in 1965, this $1 would have turned into, what is that, Nick, on the chart? $42,000 something?
It's remarkable if it's
by true. Today. And then there is a little black dotted line beneath, which comes out at about $5,000. How much you would have made if Berkshire Hathaway had charged hedge fund fees, and the S&P obviously far below it. So I think that's a very good indication why everybody all the time is positive about the market if you switch the television on, right, Nick?
Yeah, that also shows you just how much money people make in, theoretically anyway, in managing other people's money.
You played that game for a very, very long time. So obviously, a lot of people don't believe me when I say, no, actually, we like it when our clients make money because then they're happy, then they come back and we make more money because it's always, oh, you're trying to rip off here. No, not at all. The opposite is true. But the assets under management, once you've established a big bureaucracy, analysts and everything, you need to have to get fresh money coming in. You can only achieve that by showing performance, right?
Absolutely right. I mean, just a general comment, I would say, the industry is really struggling with ETFs, and in a way rightly, because there's only a small community of asset managers who are able to consistently drive, good returns for the investors. Whereas the rest just deliver so-so results. And therefore people go for a cheap solution, ETFs. It's not necessarily the best thing, but it's the cheapest thing on the table at the moment. And unfortunately what that does is that sort of takes money away from people who can actually do very well. You've got to be very selective about who you put your money with now.
Do you see a change in trends at the moment where people used to, I went through these cycles many times as well, they were foaming off the mouth, oh, give me high tech, give me the high growth stuff in your funds, the mandates that were dished out. And then eventually they shifted into, I don't want to lose any money, give me low volatility. I don't care even what the return is. Have you seen any shifts or still greed prevailing?
No, I don't think there's necessarily greed prevailing. I think people are just sort of more confused now than ever before. I mean, I've got O3C as the name of my company, as OOC, in other words. order out of chaos, and out there it's really chaotic and very confusing, and the instruments also more confusing now. Now there is a sort of the active ETFs as opposed to the active funds, and so if you're on the outside trying to decide where to put your money, I would say that it's not getting less confusing, it's getting more confusing.
Yeah. Well, whom can you trust in these markets? We all know the beautiful
that's the other thing.
That how much is it? 75-80% of institutional managers don't beat the S&P over time.
Yeah, that's the point, isn't it? I mean, we criticize retail investors, that kind of percentage don't make money on their, managing their own money. And it's about that kind of number that don't beat the benchmarks. So, as I say, you've got to be really selective. And that's not easy when when you're on the outside and you've got 6,000 funds to look at. And so, well, which one should I go for?
Well, I would clearly go for what we are talking about, even though these are not investment recommendations. And one of the trades which is actually lining up for me at the moment, I thought I have to slip that in right at the beginning. I called it almost time again. What can you see here? The S&P, and we are creeping up to, well, the all-time highs. And the market is at the moment, at least for my perception, trading extremely technical. The stories are all in. We're talking about them for years now. We had a couple of really good calls. So I had a lot of other guys out there. But all these stories have now permeated through the market. And the market seems to be a bit like, what are we going to talk about now? Well, we don't do anything. So let the algos do the trading. And the algos are looking at their moving averages. And you can see that here beautifully. We've tested the 50-day moving average, and then we went to the 21, gapped through it, and now the next stop, as announced on this channel, was, let's figure out, and don't nail me on exactly the point count. We're trying to take out the new all-time highs, and if we take those out, well, then everything might be possible. However, what trade do you set up if you don't agree with, the general tenor that there will be no recession ever again, and that we had a soft landing? I've pulled up the last longer term chart, and we're doing this now for over a year, Nick, our beautiful little talks. The last time we had a situation like that, you can see that here. Oops, that was the wrong one. If I go down to December 23, we had the same situation. Volatility in the VIX was extremely low. We're trying to make new all-time highs. At this time, I was already more bearish than bullish, but I thought, okay, fine. I swallow my pride. I don't have to be right. I want to make some money. So I bought a cheap straddle. Cheap in terms of volatility terms, because both ways were possible. That worked, The assumption is a very, very simple one in my mind to say, if we see new all-time highs or all-time highs are being tested, markets don't stick around at that level. Either they get rejected, then they take the turn to the south, or you see an overshoot to the north. And we are at that situation again. Last time it took a little bit longer to test them, but that's clearly what I'm going to do. I'm trying to assemble myself a cheap straddle. My level is at 5,250, so we haven't reached that quite yet in the S&P. We were at 5,222, and we talked in the green room about it. It's something between 3 and 6 months. Do your own math, have a look at it. But at volatility levels at the moment below 13 in the VIX again, I think it's a good trade. You're not overpaying for the odds, and you sleep well. Nick, agree, disagree?
I think that's a lot smarter than probably what I did, which was buy insurance and then go and buy it along against it. And, I like the overseas markets versus the US. I like China. I like Europe. So I'm a seller of US and a buyer of overseas, but it's another trade. And I think that's, given what we're doing in the S&P right now, I mean, it is very tricky. It is very, very, is it going to break? Is it not going to break? What's driving this thing? Is tech driving it? I mean, tech was out of favor. Now tech back into favor. It's a very difficult thing. And I think possibly a straddle makes a good sense.
Yeah, I've heard a beautiful interview from Adam Taggart from Thoughtful Money with David Rosenberg. And he was very, very bearish. Well, maybe I'm not doing him right, but he went into the data a little bit deeper. and said, what was driving the economy, this huge upturn last year? And he picked it apart, and there were basically 3 points. Fiscal spending. Everybody had a check, and they still had to blow this check out of the window. Then the savings rate went down from 9% to 3%. So people are spending their savings.
Mm-hmm.
And third point is credit cards. They are using their credit cards like crazy, up 10% in the United States. So if we say, fine, that's what he said, that almost all growth in the US came out of these 3 components. Well, the consumer is 70% in the United States. But his models, he indicated, do not see a huge return for equities over the next year, if any returns at all. And he said he's rather positioning himself on the longer end of the bond curve. What's your take on that, Nick?
Okay, I mean, we discussed this also with earnings growth. Yeah, earnings growth is expected to be upwards of 8-9% this year, right? So with earnings growth 8-9%, with dividends of 1.5%, and with multiples not extremely high, you would still expect a reasonable return from equities this year and next year, because again, forecast earnings growth is quite high. However, the spread between what you're earning in equities versus what you theoretically could earn in bond world, at least short end of bond world, is very narrow. So it could well be that sort of US equities go nowhere, but you earn the sort of earnings multiple on this thing. European, Asian stocks do well, and bonds you get carry. So it could well be not a year of disaster for markets, but just a year where you can just chug away. I don't necessarily I see a slowdown in the US. I don't see a recession. And so on that basis, I think, you're still okay in equities, but you've got to trade this thing a little bit, because you will get swings of 400 or 500 points in between, which could, sort of enhance your returns.
Yeah, I'm with you on that, especially the earnings. I have a slide here on the chart which shows how many of the companies we have earnings seasons right now reported revenue beats, and so far it's only 58% who beat revenue or did beat revenues. And what we've also seen is that when a company beats revenues, we don't have this exuberance anymore. We only saw a short 3 months. I told you in the green room, one of the trades that screwed me over was I did an earnings trade on Dell. And Dell reported, yes, they're going to increase the dividend and the company is doing well. And it did a 30% gap. Yeah, so you're in your max risk from night overnight. We're not seeing this at the moment. So if the market seems to be fairly or priced, I'm using it again, priced for perfection right here. And the Fed is keeping interest rates higher for longer at these levels. Then we bring in the 7 trillion of refinancing debt coming in over the next 2 years. Yeah, I'd also, at the moment, I have cash on the short end, but maybe I'm going out longer duration now because it's the game of total returns, yeah? How much do you get? Let's say 4.2% plus just in coupon, and then taking the convexity into the game, we could see a potential 20% trade for a year's time on the long end. If the idea...
Yeah, I mean, it's quite possible 20% is not unreasonable, but... the thing about the long end, it is quite expensive. Term premium and all of that suggests that the value is still in the short end of the curve. And for that reason, I would say for a trade, definitely the long end of the curve is fine. And at this level of 4.5%, I quite fancy, yields seeing lower yields rather than higher yields. Especially the Fed has already made a statement they're going to taper their QT much more than was anticipated. That should put a cap on yields breaking out on the upside. Janet Yellen has done her bit with a quarterly refunding announcement, sort of more bills, less coupon paper. So for that reason, I think the long end is okay, but it won't necessarily run away. I mean, you put on the trade, you make your money, and then you get out because longer term, I think the US bond market's not necessarily the place to be. And as I say, with equities, at the start of the year we came in, it was 4.7. With the earnings yield and all of that, you'd expect 8-9%. You're very close to that level now with 5.2. So it could well be that we are near the peaks. in terms of what you'd expect for such a, reasonably good expectation of earnings for 2024. So upside is definitely feels, less than the downside. But I quite like your trade because, that opens up the possibility of, if you're wrong and it does run away, then you're still in the game.
Yep, absolutely. I've skipped this chart a second ago to come to this one. It's actually, I called it do as they do, not as they say. And Warren Buffett, he just had his annual shareholder meeting, and I think two of my students were even there. I just have to collect their opinion a little bit later this evening, what they thought. But what you read in the papers is actually, he didn't really talk down the economy. He was not offering a real opinion about it. I suspect him, well, I think it's not a suspicion, he's a Democrat, right? He was always going on that he pays more taxes, or that his secretary pays more taxes than he does in percentage terms. So I always ask myself, well, then pay her better. It's a very simple solution to this whole thing. But it's usually, you know that technique as well as I do, and everybody who is not fine with it, do as they do, not as they say. And what you can see here on this chart is he's piling up cash like a madman at the moment. So why does Warren Buffett do that? Obviously, he does not see the opportunity to buy something cheap or at good valuations at this point in time. He wants to have cash when markets come down again. We all heard that he reduced his Apple holdings. And when I listened to my daughter, who ran me through the YouTube videos about the video goggles they have, they're what they're called,
visors or whatever.
They're all getting trashed by the kids out there. They are totally excited to spend $3,500 to $4,000 on these things, and then they test them out, and there are a lot of fanboys out there. They don't really like them. The last time I've heard that was about Tesla. You had the boys who went for the Cybertruck, were all excited, and then bit by bit they were chipping away. I've canceled my order because when they originally announced it years ago, I was quite excited about the Cybertruck, right? And then they didn't, he didn't hold what he was promising for it. But I said to Lizzie, so what does that mean? Old geezers like myself are not buying this stuff anymore, even though we have the money and would like to buy it. And the kids, the opinion leaders, not talking very good about these products. Maybe the Apple headset or the Cybertruck. Who's left to buy in that scenario?
Yeah, I mean, a couple of things. Firstly, I don't think Warren's been watching the grey market talk, but I've been slagging off Apple stock for a while.
You never know.
So he's the one. So that's the first thing. He's out of a stock which was one of the darlings of the driver of the stock market rally for the last couple of years. Apple themselves are a seller of their own stock. I mean, at the end of the day, although they buy back their stock, they're effectively saying, they can't make as much money on internal development by using this money than they can by just saying, okay, we can't use the money here, have the money back. It kind of helps our earnings per share, makes our CEO a little bit richer because he gets paid on that kind of performance. Whatever the reason might be, what it's saying is that these growth companies that were driving a lot of this sort of recent rally in US stocks are now becoming, how should we say, a little bit more mature than what they were earlier. And for that reason, you don't expect so much growth in their earnings. And so, in that respect, I would just simply say, this is the first message of all of this. And 1 second, my phone is buzzing. Sorry.
It's Warren.
It's still picking off Apple. Yes. Yeah. So, these are the worrying signs. And when he is piling up his cash pile here, I mean, what's he saying? He's saying, well, you know what? It's that story that we talked about earlier about you can earn a decent amount of money for a short period of time in the US bond market. I mean, all of this 150 billion is that of cash is earning 5%. Good luck to him. So he's got no risk on that whatsoever. He doesn't have any mark to market, and he can just sort of sit it out until he sees something. And I think that's not a dumb thing. And if what you're selling is Apple, that's quite a smart thing.
Yeah, with Apple, I'm writing a piece about that at the moment because one of the things I mentioned that in some other program on this channel before, when we had Murad's Monthly, I said Apple, they announced the buyback of 110 billion in shares, right? And the market gapped to the upside and increased the market value of the corporation by 160 billion overnight. Yeah. And then I started thinking, I thought, why is volatility in these markets so depressed at the moment? And then it hit me like a ton of bricks. Obviously, I'm not a market maker behind the screens anymore, but in my opinion, it could well be that the companies have evolved. In the olden days, they gave an order to an investment bank and said, you have a mandate for, let's say, 6 months. Yeah? And whenever the stock hits a certain level, you go in and stabilize the price, buy it up. Fine, lovely. But they're not stupid. I think they are in the business of selling puts now, these guys. You have Apple, the treasurer, says, you know what, 110 billion, fine, I could give you the money and you start buying whenever we say there's a certain level reached. On the other hand, why don't I, as a treasurer, sell put options? What does that mean? I have to buy the stock back at this level I've agreed on, but you pay me a premium for it in the meantime. So what's happening now? The market maker at the bank comes in one morning, all happy, and his investment banking colleagues tell him, oh yeah, by the way, make me a bid for, I don't know, 1 billion in Apple shares or put options. And you say, oh, for fuck's sake. Okay, fine. You give them a good price. So suddenly you're along all this volatility, which Apple just sold to you. What are you going to do as a market maker? You're price insensitive. You just don't want to get screwed on your book. You start selling it. And that, with all the large companies who do that big style at the moment, explains to me why the VIX is not having these spikes at the moment. The market hasn't overrun them. Yeah? There's too much material coming out because the treasurers are getting more sophisticated in their way of managing their own stocks. So they're flooding the market with volatility. That's why you have Apple volatility in extremely low IVR rankings and saying, yeah, fine, that is an explanation for what we're seeing. And that permeates through, obviously, to the VIX levels we are seeing, until the big event happens and everything is blown out of the water. But in the meantime, you are in this, well, almost stable equilibrium. Just a theory. I'm trying to find some data about that and speak to some old colleagues who are still sitting behind the screens, whether I'm on the right track there. But that would finally give me an explanation about what's going on.
Yeah, I mean, that's quite plausible, isn't it? You're right. You'll probably see it somewhere in their notes to the accounts, or in the announcement of the share buyback. Or, did Buffett sell the cash, or was he selling calls, or what was he doing? I also don't know. Point being, you're right. There's a far more sophistication by these treasurers, and so that could well explain what the kind of price action we're seeing right now in Apple.
So, well, we've already dished out one trade idea. I'm having, at least at the moment. Let's go further through. We had this already. I think we don't have to go on the cycle again. We are still both gold fans. At least I am. Nick, you as well?
I haven't not been a gold fan for the last 20 years. So, gold, crypto, absolutely.
It's one of the pieces of advice we like to give to our younger viewers or people who just start in that industry. It's always very tempting. You have a good idea, but you're not making any money on it. And then suddenly it makes 10 or 15% and everybody's getting itchy to sell it, to realize it. No, that's not the time to do it. You stuck with an investment which wasn't performing too well. Now the market finally starts moving. There's a reason behind it. Yeah, people shifting their perception, people shifting their ideas about this asset. So sit tight. If your idea was good half a year ago or a year ago, and the data points haven't changed, you should stick with it. Don't get nervous, because especially these longer term trends, they don't die overnight. You have clear indications about it. Just a little piece of advice from an old market maker. Fear and Greed Index, before we come to the real highlight of the show, obviously, and I will ask Nick again to adjust his microphone. That was a couple of weeks ago. We were neutral, then we were fear. We called the low, the temporary low in the market. Then we went back to neutral. Markets were trading technical, and at the moment we are in neutral scenario. Obviously, we're trying to, what we started the show with, retesting the old all-time highs in the S&P. Before we come to your point, one interesting explanation. I was talking about that with Murat, and we were talking about it as well, why utilities were performing so well. I had a nice new explanation for it, because usually you have the performance first and then people coming up with the explanations. It's AI, Nick, apparently. And you know why? Because AI is using so much energy that people now starting getting itchy on buying themselves some utilities. Because if you do a large language model search, that's 50 times the energy you use if it would be a normal Google search. So people saying, no, I have to definitely get the guys who provide the good that all these AI technology can work. Frankly, I still think it's bullshit. Utilities usually start rising when people sniff a rat in the market, and suspect that interest rates might come down, and it's safe investment. But I like the explanation for it. Your thought on that?
Yeah, I mean, okay. I mean, I don't like narratives. They're great for having a chat in the pub about what and why and all of this stuff. But I think the normal kind of cycle of what happens at tops of markets and what happens at bottoms of markets is kind of tried and tested. And Murat's done a good job to explain which sectors do well at the top and which sectors do well at the bottom, and how this thing kind of rotates through this RRT. And at the moment, it has, at least, as the market started to fall, it looked timing wise great, with tech coming out of the leading sector, and the classic energy and utilities and health, which were starting to perform. It looked like a great market for a top, and that's the only thing I'd say, is that these things perform their defensive plays in that kind of market environment. But narrative is narrative. It's not for me.
Lovely that we agree on that. So my straddle still holds. So I got the left one in my inbox, and I thought that's our new announcement when we're talking about Elliot Wave. Beauty in nature. You can actually see the beautiful Fibonacci spiral on the gentleman's girth. Let's put it that way. And immediately after redistributing it, one of my students sent me the picture of Don Fibonacci. So you see beauty in nature everywhere. And I've asked Nick before, Nick, are your charts ready? Have you updated? Can you give us a quick run through what the magic world of Elliot Wave is telling us?
I will try to.
That's what's coming next. So you have the bridge, Nick. I think I shared already. You can open if you want to.
Yeah, I will do my best. So I'll put it on the desktop first, and then see. And as I say, I hope these things are updated, or at least this is oil, by the way. So don't know why I had that one up there. Oil price versus treasury yields. Yeah, I mean treasury yields here in red. I've been a bear for oil. Oil is doing one of these three-wave moves, could just simply be a correction, but I do quite fancy oil to go down much further than where it is now, primarily because there's just too much of it out there right now. But I know you didn't want to talk about oil. You let me know which markets you want me to look at first.
No, oil is actually quite interesting. One of the things geopolitically which went through my mind is you hear the news now everywhere that Ukraine is having a bit of a hard time. It looks as if Charkiv, how it's pronounced now, is under pressure. A couple of the YouTubers out there who have connections into the Ukraine say they're running out of young men. Yeah, it's simply this war in the current condition cannot be sustainable anymore. So in my head, there are now two opportunities. Either they start negotiating, or they start sending rockets directly to Moscow to escalate the whole thing. That is one of the really crucial, brutal points we can see here at the moment. In a strange way, both should have positive impact actually on the oil prices, right? Peace would be good for world economy, and an escalation of the war should be also good for oil prices. So where do I miss the downside, Nick?
So, firstly on the political side, peace is a wonderful thing, and we hope for that. But it's not really been the driver of oil. At least it's not a sustained driver. I think when the initial kind of shock of sanctions and you got to go and buy your oil somewhere else, there was this pop up to $130 a barrel. But if you notice since then, what have the US been doing? So first thing that the US did was they pumped out their strategic petroleum reserves, 1 million barrels a day, which is substantial when it's being done for a while. They haven't replaced it. I think they're still in that reduced mode, not sure on the latest, but more importantly, at the same time, the US have been turning on the pumps in the States, so they have been pumping out oil like it's going out of style. So, I mean, they are massive producers of oil, massive producers of gas. Tell me why, these things should be going up in price when there's so much supply. OPEC are unable to stem the kind of the flood of oil. The world economy has just taken advantage of it. Cheapish oil, I just can't see the catalyst for oil to really start to rally, because there is an abundance of oil at the moment. It seems out there. The only catalyst would be when supply chains break down, and I think they've had a long time to kind of replace those supply chains, since the invasion. And even, the Europeans are buying Russian gas and oil. I mean, it's finding its way into the system, through the back door, as it were. So, they have managed, this thing reasonably well. And, I look at the charts, and, this thing is from it's not the high from post war, but if I just go on to a different time scale, 3-day perhaps, maybe that's a bit clearer.
Well, one of the points actually that would speak for your thesis, if good old Mr. Trump becomes president again, that would also have a huge impact on supply, right?
Well, I mean, that's a question mark. I think, I think he's certainly a lot more friendly towards, oil and gas licenses, which is different to the Biden administration. And for that reason, I think, there's more likely to see certainly more opportunity for these oil companies to pump than there has been. So this is pretty much the high post the invasion, if you like. You see here, 2022. And what we've done since then is very choppy and sideways. And it could actually be, the famous triangle. I mean, I've not drawn it as a triangle, but looking at this thing right now, it could be a triangle. And that just means, we had this sort of correction down 2022 down to March 2023, first leg. Then we had another choppy kind of move up, another kind of 3-wave move, corrective move, another choppy kind of move down and up. Could well be that the whole thing is just some kind of sideways triangle and we don't break this low. But if it is, the alternative Elliot Wave count is one which says, this is, I don't know how else to draw this, but if I just draw a line here, I'll say, purple line here, step 1, purple line here, step 2, and then purple line here, step 3, down to, the $50 kind of level.
So in your interpretation, we haven't closed the C wave yet. Yeah?
Yeah, I mean, if it was a triangle, then basically you would expect sort of wave A, wave B, wave C. That was wave C down here. If it was a triangle, wave D up here, and then wave E doing now, and then after wave E in the triangle, if it's a bullish triangle, you would expect this thing to shoot up $150 a barrel. It's quite possible. Yep. I mean, it's not, this is, the structure doesn't exclude that as a possibility. And the only reason to stop that thesis is if oil drops below here, $68 a barrel. So that option is open. It's just because of the supply situation right now. I'm saying, well, okay, I actually think oil is likely to cheapen up. And if you look at there's a good analyst, I think it was Doomberg, who looked at the kind of the price of oil versus gas. And the price of oil versus gas is just, gas is so cheap. I don't know how else to say it. Gas is so cheap. why the hell would you pay so much for oil when you've got a far cheaper energy source that you can build into your sort of processes and use gas instead of oil? And I think a number of countries have actually been doing that. Even the Saudis have actually replaced some of their oil internally with using gas, saves them 1 million barrels a day. So, with gas being so cheap, I think I quite fancy for oil to come down, but it doesn't really exclude this sort of alternative view of a sideways triangle before a rally. But as I say, that's not my kind of base case here, but it is still an option.
So you see a target of around 66, 65?
Well, down here, I would say sort of see a new low, be in the 50s, and I think that's not unreasonable, and it's not implausible. What you see overlaid on this chart, if you can, perhaps this red line here is 10-year bond yield. So you can see how they have kind of tracked the oil price, since at least sort of 2023. So prices go up, yields go up, prices go down, yields go down. Now, I think that's just the inflation kind of breathing, in the markets. But there is definitely a correlation. Currently, there's a regime correlation between oil and yields, and that would, given that I'm kind of bullish on bonds in the near term, so from 450 down to below 4%, then if yields do go down, and this is an inverse thing. So if this red line goes down, that's yields going down. That would be kind of in sync with a lower bond price as well, lower oil price as well.
All right. Well, that still fits in my old theory that if oil prices have to go down, we see a recession. In a recession, interest rates come down as well. Super trade still on.
Yeah.
I love to simplify your high value thoughts, Nick.
You translate everything to English for me. That's very kind. Right. So you wanted to talk about S&P, I know.
Yes, because, definitely.
The S&P, right? This, if you remember the last time we spoke about this, so I'd labeled this thing, this level here. I can't remember where it was. We were thinking March or somewhere around here, saying looking for a top. Wave 3, looking for a correction. Market then sort of starts to go this correction should go down here. So wave 3 and then 1, 2, 3, 4, 5, and I've got that kind of label here. And I said, okay, so that's a possibility. And what we would like to see for that possibility to be a high probable count, if I just sort of move it on a 2-hour chart, get a little bit of a closer view, is that I don't want to see this rally, this recovery in wave 2. I wouldn't want to see that above a strong Fibonacci, resistance point, 78.6%. And that 78.6%, you will note that on the 9th of May, so in the last 2 days of trading, we've actually traded above it. And normally what is needed is 2 days closing above the 78.6% would imply a strong chance of this thing breaking, and obviously, the market then breaking the all-time high. Where does it target? And a long time ago, we talked about reverse Fibonacci targets for stock markets, and we said what you should normally do is you basically look for the last high and look for the last low, and you put a 1.382 multiple, 1.272 multiple, and those levels are here. You can see them up here, and that's sort of around the 5,300 area. So we're even if you're bullish, the upside at the moment looks fairly limited. And I did an alternative count to show what what the bullish view might be. This is one, but I think we spoke about this one. So what we talked about here was the length of corrections. In August 23, the market corrected to November 23. And then we had this quarterly refunding announcement, which got everyone excited. If you believe that, and the market started to rally. And then I said, okay, if there's going to be a correction, we want to see corrections be of a similar nature to previous corrections. Now, we had a correction here in December, January 24. And then we had this correction, which was tech-led. Tech moved out of the kind of leading area and into underperforming. And the market got sold off. And the length of this correction, the time length, was the same as this time length. So that got me thinking, if the two are very similar, then the bullish count does become a much stronger alternative, but not too far away. So how far would this thing go? And you can see here, I'm labeling here a low, and then sort of it's working its way up here. So there should be a squiggle down, squiggle up, squiggle down, and squiggle up. And then that would be sort of a more significant high already here. So it opens the door, this chart, for a slightly higher high than where we are now, sort of the 5,400 area or thereabouts, before the next major sell-off. And what I did was, I also sort of looked at what other structure could this be here, and I've drawn this pattern here, which is called a flat. And basically what happens is you get wave one down, wave A down, wave B up, and then wave C down. That would mean a much longer time horizon correction. And if that longer time horizon correction is in play, then it means that it's probably more like this little baby here, which happened in August 23 to November 23. And again, that would sort of point to a much longer and a deeper correction. So in all, it's not really a big trend. It's not an obvious thing what way to go, up or down. We're kind of near the targets on the upside, but the structure and the path on the upside could take sort of one of two major forms, yeah. And that's why I watch this thing kind of like a hawk. You can see I've got it on a 45-minute time thing here. I mean, what investor looks at 45 minutes? It's a 15-minute chart, and I'm labeling all of these little squiggles because I think in such an environment, you've got to really watch the nuances and be ready to make a play, when it's appropriate.
So to sum it up, in both wave count alternatives you have here, yes, there is room to the upside, but the room to the upside is actually quite limited.
Yes, and that's because that was a wave 2 here, that was a wave 4 here, and after wave 4 is a wave 5. The wave 5 should take a Fibonacci ratio versus wave 1, which is sort of, if I just take 61%, wave 1 was quite long, that means it's sort of 5,400 or thereabouts, which is not a million miles away from where we are today. So if you're a longer term investor, if you're Warren Buffett and you've got a chunk of Apple stock to sell, you're not going to leave it to the top tick to get out of your Apple. You say, okay, we're in the last 5%, get out of this thing. And that makes the most sense. And I think, if we were going up from here, I don't see more upside than that. And the alternative is, this chart here, which was a much more bearish view, but the alternative became less probable when we started to break this 78.6% on Thursday. And just for the record, NASDAQ hasn't broken that level yet. I hope this thing works. I'm going to try it. Yeah, look at that. So Here is NASDAQ. Here is NASDAQ, you see. So I've got the same kind of view on NASDAQ as I had on that very first bearish chart, the S&P, where the path looks like this. If I just sort of highlight the red thing. So the first wave down, then a strong retracement up to about 80% is acceptable because this was a 3-wave move. 3-wave move is never the end of a move, right? So this 3-wave move needs another 3-wave move if it's going to come down again. And that 3-wave move has to go to about 80%. And it has. It's sort of at the 78%, but it never closed above it. And certainly not 2 days worth. So it's traded to around 80%. That's acceptable for me. and that opens the door to still a much larger correction in the Nasdaq, unless we do like we did on the S&P, where we sort of dither and sort of go up above this level for a couple of days, and then that might well trigger expectations of higher prices in the Nasdaq. But when I look at all these tech companies, they don't look too clever. Is all I can say. You know, there's nothing in them that you'd say. You know, if even Google is now a dividend play. So you know, in that kind of world, you know, why would you really think this thing is going to run away? You want to see what new industries are coming up. You want to see the stock market kind of benefiting from this AI, and I think that's probably years to come. So, as I say, my preference is for more downside than upside. We may well dither and sort of break a little bit on the upside, but I don't see too much on the upside right now. But that technical resistance on the Nasdaq is holding.
Well, that is in line actually how I constructed my trade at the beginning. What I would do, I would take some deltas off the table if we have the overshooting into the region of 5,450, 5,400 in the S&P. Let's see whether the Nasdaq is confirming that. And finally, the lag effect will eventually kick in. Yeah? The economy is not as it is perceived. The narrative is getting wider spread now. Also, if you look at all the financial pundits talking about it, the good ones. So yeah, I think you have a reasonably good chance to make some money on both sides. First to the upside, and then to a longer downside.
I mean, the way that I've been positioned in the last month, I'm short of tech. So short Microsoft, I was short Apple. I bought them fortunately back cheaply. I was short Tesla. I bought them back cheaply, in 145. So I was short S&P, short Nasdaq, and I was long against that defense stocks. I was long against that China. I was long against, and actually, sort of my shorts became the S&P and Nasdaq shorts became sort of fairly worthless, which they do. But the good stuff, fortunately, is going up. You know, these defense stocks are going up. China is going up, and that's worked out sort of reasonably well so far. And I still have some of that on. You know, when we look at Bitcoin was one of your sort of asks a while ago.
Yep.
And again, we've got that similar situation that I showed before. I said, well, look, there is a correction here, you know, between, what was it, April 23 and August 23. And that was quite a long correction. And I said, well, if we're going to get a correction, we have to match the kind of make it look, you know, what matches with what. And you can see this box here, which I draw on the left in 2023, has lasted pretty much to where I'd marked the low in Bitcoin in May the 1st. And here we are sort of still working our way into this sort of length here. So it doesn't surprise me that Bitcoin has done absolutely nothing since March, right? And that's kind of the significant message. Message is, you know, we haven't done anything since March. Am I surprised? Two things I said. Well, if it's going to correct similar length to this time horizon, well, then we're not going to see some move upwards for a while. And the other thing I said, and I honestly don't know if it's on the screen, it's dangerous to show it here. No, okay, I can't, okay, that's just too tough to find. Basically, the Bitcoin cycle is still, I draw a cycle chart and I explain, I said, look, the other thing going against Bitcoin here, when we spoke about it in March, was that the cycle, the daily cycles in Bitcoin were pointing lower. And they're going to be pointing lower until the end of this year, roughly, give or take. So that means there is a kind of a downforce in Bitcoin, a bit like you know, Murat's cycle analysis and the like. We, you know, I have a tool which monitors that for various instruments, and currently there is a down cycle still in play, obviously with Bitcoin. So it is quite heavy. right? And it doesn't mean that it collapses, doesn't mean anything like that, because in the bull market, sideways is usually enough for a down cycle. But it just means that it's going to be hard work to kind of rally from here. And, you know, we saw that at least for a couple of months, and we have to see. I mean, there's been net selling in the ETFs. Last week was the first week where there was a positive ETF for the, you know, last 5 weeks. Everyone was selling for the last 5 weeks, and last week was the first positive inflow for the Bitcoin ETF. So it could well be that they get a little bit of a kick, and maybe that sort of fits with the timing, where we say here was the low towards this end of this sort of timeline box, which I drew. You know, we'll have to see.
So what am I going to do, Nick, in Bitcoin if I want to do something?
Well, I am, you know, so again, positioning. Sometimes you trade the squiggles and sometimes you don't. And you know, on gold, I've not traded squiggles. On Bitcoin, I've not traded squiggles. These are things for the longer term, and that's how I play it. On everything else, I am sort of very closely watching. I think, as I say, S&P. I'm short the index and long of other things against it, and I think I still have a long delta. I'm still long, net long, but I quite fancy a trade like, you know, your straddle, because that sort of gives me a kicker on the downside in case I need it.
Well, with the straddle, it's if you don't mind, I stop now the sharing. Or can you do it? How do I do it from here?
I will do it because there's obviously a button somewhere. It says stop your share and stop share. There we go.
Yeah, no, the straddle is obviously, it's not one of the most exciting strategies one could have out there, but it makes sense, especially if you are being brought to these points. Yeah, well, you have to put a little position on there. It worked in the past. We've all seen that. If you test new all-time highs, markets don't stay at all-time highs. That's also true for individual stocks. So yeah, it would be stupid, especially if volatility is cheap, to say, well, I get me some of that, and you sleep well. I like sleeping well, especially in these wild times we have. Nick, thank you very much for the highlight again of the day. The magic we can see here in Elliot Wave. I like it, especially when it reaffirms my predisposed opinion, which comes in here. And yeah, well, let's see what happens next week. Anything exciting?
Well, in the markets, we got CPI next week. That usually gets the market excited, doesn't it?
That's why I was asking a little bit facetious. the CPI, again, coming back to the interview with Rosie, he said, yeah, CPI, the Fed is focusing on the CPI, and you mentioned the owner equivalence rate last talk we had, which is 27% of the CPI number.
Nonsense.
And that's how they make their policy decisions. That's why I was asking. Anything exciting next week? Yeah, but we will see. Don't trade around CPI, right?
Well, I mean, you know, as I say, I mean, if I didn't see the interview that you're referring to, but if he's brought up, you know, I think I know how he thinks anyway. But yeah, I'm not a big fan of this whole CPI thing. I think it's a ruse, and I think it's got everyone confused about what's really going on. You know, they can't afford higher rates, and that's it. Full stop. Get used to it.
Yep. Absolutely. Thank you very much for this delightful interview, my friend. Especially your green screen is really giving me joy. Now we have to fix the microphone issue, and then we're absolutely back on track. Any last words from you, Nick?
Have a nice week.
And you. Bye-bye.
Bye-bye.